Assalamu alaikum dears, and greetings to all of you. Welcome dears to this video. I would be delighted to introduce an informative and quick session in this channel, which focuses on Islamic finance insights. Please support us by subscribing and following upcoming videos. So, let's start our session. Money and capital markets in Islamic finance. There exist comprehensive surveys of the growth of Islamic financial markets within Muslim countries and their global spread in competition with the interest-based mainstream markets in the normal run and during financial turmoil. There are numerous types of financial markets, but we restrict the discussion here to two: money and capital markets. Money markets. The money markets are the providers of highly liquid, very safe, short-term debt securities. Because of these attributes, the securities are often seen as cash equivalents interchangeable for money at short notice. These markets are vital for the smooth functioning of a modern financial economy. They allow savers to lend money to those in need of short-term credit and allocate funds toward their most productive uses. These loans, often made overnight or for a matter of days or weeks, are needed by governments, corporations, and banks in order to meet their near-term obligations or regulatory requirements. At the same time, it allows those with excess cash on hand to earn interest. The securities include short-term treasuries, example T-bills, certificates of deposit CDs, commercial paper, repurchase agreements repos, and money market mutual funds that invest in these instruments. The transaction tenure using these instruments ranges from overnight to 12 months, the commonest being less than or exactly 3 months. They are no less crucial for the smooth running of an Islamic economy than a secular one. It provides Islamic financial institutions with facility for raising funds and adjusting portfolios over short term. It enables Islamic banks to resolve their liquidity problems, specifically to handle the assets' liabilities mismatches. The central bank, in controlling the level of liquidity in the system, employs the money market for the transmission of its monetary policies. Governments and business organizations also find the money market useful for short-term investments and for raising short-term funds. Thus, it is indeed a venue where banks, businesses, and government can buy and sell money instruments and invest their surplus funds. Financial instruments and interbank investment allow surplus banks to channel funds to deficit banks, thereby maintaining the funding and liquidity balance. Short-term instruments in Islamic finance are financial products that are designed to provide financing for a period of less than 1 year. These instruments are compliant with Islamic law, which prohibits interest riba, gambling maysir, and uncertainty gharar. Some of the most common short-term instruments in Islamic finance include murabaha. It is a type of Islamic trade financing that is based on the concept of cost plus profit. A financier purchases an asset on behalf of a customer and then sells it to the customer at a profit. The profit margin is agreed upon in advance and is typically based on the financier's cost of financing the asset. For example, a business needs to purchase a new machine to produce its products. The business approaches an Islamic bank for financing. The bank purchases the machine on behalf of the business and then sells it to the business at a profit. Murabaha is a popular short-term financing instrument because it is simple and easy to understand. It is also compliant with Islamic law, as it does not involve interest. Wakala. Wakala is a type of agency agreement that is used in Islamic finance. Under wakala, one party, the wakala, appoints another party, the wakil, to act on its behalf. The wakil is obligated to act in the best interests of the wakala and to carry out its instructions. Wakala is often used in Islamic finance to provide short-term financing. For example, a business needs to import goods from another country. The business approaches an Islamic bank for financing. The bank agrees to act as the wakala for the business and to arrange for the financing of the imports. The bank will then purchase the goods on behalf of the business and arrange for them to be shipped to the business. Wakala is a popular short-term financing instrument because it is flexible and can be tailored to the specific needs of the business. It is also compliant with Islamic law, as it does not involve interest. Musharaka. Musharaka is a type of partnership that is used in Islamic finance. Under musharaka, two or more parties the musharaka pool their funds to finance a project. The profits and losses of the project are shared in accordance with the agreed upon profit-sharing ratio. Musharaka is often used in Islamic finance to provide short-term financing for businesses. For example, two businesses decide to collaborate on a new project. The businesses agree to form a musharaka and to pool their funds to finance the project. The profits and losses of the project will be shared equally between the two businesses. Musharaka is a popular short-term financing instrument because it allows businesses to share the risks and rewards of a project. It is also compliant with Islamic law, as it does not involve interest. Ijara. Ijara is a type of leasing that is used in Islamic finance. Under ijara, the owner of an asset, the lessor, leases the asset to another party, the lessee, for a fee. The fee is typically paid in installments over the term of the lease. Ijara is often used in Islamic finance to provide short-term financing for businesses. For example, a business needs to lease a new vehicle for its operations. The business approaches an Islamic bank for financing. The bank agrees to lease the vehicle to the business for a monthly fee. The business will then pay the monthly fee to the bank over the term of the lease. Ijara is a popular short-term financing instrument because it is flexible and can be tailored to the specific needs of the business. It is also compliant with Islamic law, as it does not involve interest. Qard al-Hasan. Qard al-Hasan is a type of interest-free loan that is used in Islamic finance. Under Qard al-Hasan, the lender does not charge interest to the borrower. The loan is typically repaid in installments over a specified period of time. Qard al-Hasan is often used in Islamic finance to provide short-term financing to individuals and businesses. For example, an individual needs to borrow money to pay for medical expenses. The individual approaches an Islamic bank for a Qard al-Hasan loan. The bank agrees to lend the individual the money without charging interest. The individual will then repay the loan in installments over a specified period of time. Qard al-Hasan is a popular short-term financing instrument because it is a compassionate and ethical way to provide financing. It is also compliant with Islamic law, as it does not involve interest. These are just some of the short-term instruments that are used in Islamic finance. Insha'Allah, in this channel we'll present all of them separately for each. The Islamic financial industry is constantly evolving, and new products and services are being developed all the time. The meaning of the short-term instruments in Islamic finance can be summarized as follows. Murabaha, a sale of an asset at a profit that is agreed upon in advance. Wakala, An agency agreement in which one party, the wakala, appoints another party, the wakil, to act on its behalf. Musharaka. A partnership in which two or more parties, the musharaka, pool their funds to finance a project. Ijara. A leasing arrangement in which the owner of an asset, the lessor, leases the asset to another party, the lessee, for a fee. Qard al-Hasan. An interest-free loan that is provided to help someone in need. These short-term instruments are designed to meet the needs of businesses and individuals who are looking for financing that is compliant with Islamic law. Capital markets. All sorts of financial markets need capital for conducting their operations. They differ with reference to their objectives, the time dimension of their contracts, and the instruments they use. Money market transactions are of short duration, and their instruments are mostly what the economic activities generate. In contrast, capital market transactions are usually long-term and are related more closely to the real economy. These markets bring together the businessmen who need money to invest in risky but lucrative ventures on the one hand, and the money savers who carry surplus funds for their gainful utilization on the other. Capital markets provide them with a meeting place. They choose the instruments they agree to use. It is difficult to categorize these instruments. Can divide them into direct and indirect modes. Musharaka is a direct mode when banks use it for financing a project in partnership with others because it is related directly to value creation in the production process. However, the same mode becomes indirect if a bank uses it for acquiring part ownership of an existing asset with the stipulation that the client will purchase that part by paying periodic installments determined on a cost-plus basis. Indirect modes thus allow financing to facilitate the buying and selling of goods. No value added is involved. There is another example of this sort. Bakara Sadr is the lone exception in preferring another principle over the profit and loss sharing model for Islamic finance. He holds that financial intermediation could be provided on the principle of jwala, where the bank charges a specific fee for doing specific work for the client. However, it is the cost plus or markup sale or murabaha that takes center stage. Indeed, the mode has emerged as the leading species of a large genus. Most Islamic banks have a significant pool of murabaha receivables and exposure in either ijara or declining balance partnership financings. In order to achieve liquidity, they are allowed under most Sharia rules to blend the receivables and the assets for sale to investment vehicles. In order to reduce their liquidity risks and to grow their businesses, most Islamic banks are actively engaged in product development and portfolio diversification in order to overcome the limitations of murabaha products. In this point, we reach to the end of today's session. I hope that this video provided an informative and quick session. If you are interested in this area, kindly subscribe in the channel because we are planning to provide deep information as well as the latest reports and news about Islamic finance. We look forward to your subscribing, your like, as well as your suggestions in the comments. Have a good time and best regards.